in, and we'll also thank Vivek on that note for highlighting ABB. We've got a guest waiting by to chat with us. Ravi Dharamshi, the Chief Investment Officer at ValueQuest Invstment Advisors, is with us on the show now. Ravi, 7 good days on the trot, but we are now entering a period of heavy news flow, especially in terms of earnings growth. Are you buying anything in the Indian markets right now, or are you waiting for the earnings season to play out?
We have been fully invested through the last 15-18 months. 15-18 months have been a period of correction, consolidation that we have been going through. So if you had told me, that next 15-18 months are not going to be good and there's going to be a war and there's going to be a spike in crude and interest rates are going to go through the roof, I would have said our index would have been down 30-odd% easily. But given that fact, and we barely managed to correct by about 15-17%, and half of it which we have already recovered, tells you that our market is still in an uptrend and it is unwilling to go down. Even fundamentally, if you see the macroeconomically, the way we are poised, we are very different from the developed world. Developed world is facing an inflation issue and interest rates issue. RBI is actually taking a lead, and it's a very surprising and bold move that we have actually paused before Fed. So it is clearly the inflation differential that is reflecting in the RBI's confidence. The rupee dollar remains stable. Forex reserves remain stable. Current account deficit is under control, and fiscal deficit is also on a glide path towards a lower number. So I think India's balance sheet and India's macros are actually in a much better shape than the developed world. And that is what is reflecting in the markets as well overall. So I think markets have done correcting. Of course, it's not going to be that we are going to start making new highs immediately, but more constructive view on the markets is warranted now after the pause by RBI.
All right. Hi, Ravi. Good afternoon. Yeah, absolutely. To put it in cricketing terms, it's like that batsman who's standing out there and, the bowler's going on bowling those bouncers. It's hitting him in the helmet, but still the Indian markets, we have battled the storm. So maybe we're in for a bigger innings from here on. But Ravi, the big talking point for the next few days is going to be the IT space, because tech numbers are going to be coming in there. And the street is clearly a little bit cautious looking at the index itself. But I think in the past, you all have been a little bit positive on a couple of themes, the ER&D space, if I'm not mistaken, KPIT. What's your view on the IT space, and do you like anything at these levels, or would you rather stay away?
So, Nigel, let me correct you. We have actually been a little negative on the IT space.
Right.
In fact, our allocation to IT is in low single digits, if at all. And even within IT, we are not so constructive on IT services, so to say. The stocks have corrected, adjusting for the fact that there is a headwind in the biggest market, which is US and Europe. So now probably the margins have bottomed, but I still feel that the growth is going to be a little bit of challenge for the next couple of quarters point of view. We are more focused and maybe more positive on the IT platform companies.
Okay. So you like some of the IT platform companies. Ravi, hi, good afternoon, Surabhi here. You have been a big proponent of banks, right, for some time. You're a big believer in, a multi-year compounding story. So I want to ask you, how exactly are you playing it? Private versus PSU, large versus small, NBFCs versus, top-of-the-line banks. What are you most convinced on? Because if we look at the business updates, at least Q4 updates, I think barring one or two like a Karur Vysya or a Karnataka, I think, where there was a business compression, lack of growth, everybody else has shown a lot of growth. So then what makes it to your portfolios?
So let me just expand the bank's definition. I would say we are positive on financials per se, lending as well as non-lending space, but more bullish on lending space at this point of time. Within lending space, we are bullish on private banks, we are bullish on NBFCs as well, and we are bullish on some of the housing finance companies. So asset financers, housing financers, and overall MSME business lending is what we are bullish on. So the thesis is quite simple. The valuations are probably at a 5-7 year low. Even for a leading bank like HDFC Bank, this is one of the lowest in terms of price to book or P multiple it has been over a long period of time. And of course, there were genuine reasons for it. There was a management transition, there was a merger overhang, and there was some costs remained elevated for a long period of time, and the deposit growth was not coming. But now, if you see since last 2 quarters, that delivery has started happening. The growth is coming back, the deposit growth is coming back, and those overhangs are behind them. So, I mean, I'm just taking an example of HDFC Bank as a representative of the overall lending space. Nobody is talking about NPAs anymore. Okay, if you listen to any of the banking con call, nobody talks about NPAs. It's all about growth, whether the growth will be better than industry or it will be less, which area the growth will be, and of course, which products are the ones that are showing the maximum growth. So from that point of view, the balance sheet is there, it is well capitalized, economy is on a cyclical upturn, and financials are the best way to play it. So we have our biases in terms of, yeah, sorry, go ahead.
No, Ravi, I take your point, and precisely because of those reasons, I remember, I mean, for us as well as, you know, stock market journalists, we would always look at the GNPA number, the first thing whenever a bank would report earnings, right? But that's a thing of the past now. And it's a great sort of situation to be in. How much can multiples expand is my question. I think a lot of banks are still trading between 1.5 to 2 times price to book. As we go through the cycle, are you prepared for 3.5? Some of the NBFC or some of the lenders like Bajaj Finance have gone to like 6-7 times. What kind of valuation multiple expansion should we be prepared for?
So, you know, I've made this mistake in the past of anticipating how much the multiples can expand, and one should not try and do that. Instead, what should one focus on is where are we in the ROE improvement cycle? That is what one should be focusing on. If the bank that you're referring to, if the ROEs are still closer to, let's say, I'm saying ROAs are closer to 1.5% or 1%, and it is on the improvement trajectory to 1.5%, and the leverage is also still low in terms of 3-4x, then you know that there is a ROE improvement trajectory ahead of you. And as long as that ROE improvement trajectory is there, you should not be too worried. There was a little bit of concern that because of the interest rates going up, especially for the NBFCs, the NIMs could contract. But now that we can say that, okay, the RBI has paused. Okay, they might have not pivoted, but at least they have paused for the moment. And if Fed also pauses, then there is that overhang is also gone in terms of NIM compression. So even NBFCs will do well. Companies that have the clean balance sheet, are well capitalized, and can grow upwards of 20% are the banks that you would ideally like to focus on, where there is also an visibility of ROEs going from, say, 12-13% to 16-17-18%. Those are the banks and NBFCs that we would like to be associated with.
Okay, all right. Interesting conversation as always, Ravi. Thank you very much for joining us today, and we look forward to the next time we will connect with you. Well, on that note, we also have to take a very quick break. We're just after 3 o'clock and the market's holding up quite well. Nice century on the Nifty, and banks are really leading from the front. Quick break. We will come back as